Hello, everybody, and welcome. Hope everyone is having a wonderful summer. I'm Betsy Kenyon. I'm the Director of Marketing here at Elevate Wealth Advisory. We have some new people joining us today. So, for those of you who don't know us, we are a wealth advising firm based out of Athens, Georgia, and we help clients with a variety of tasks, everything from investments to advanced planning topics such as tax planning, retirement planning, and then, of course, today, IRA planning. I'm extremely lucky to have Clarke Holt with us today. Clarke is our most tenured wealth advisor at Elevate Wealth Advisory. He's also our Chief Compliance Officer. He's been with us 22 years. Is that right, Clarke?
23, 23.
23 years. So he's wonderful on this topic, and I'm so pleased to introduce him today. And so, Clarke, how are you doing?
Doing great. Thank you, Betsy.
Glad to have you with us. And
Thank you.
Clarke, what are you listening to, watching, or reading lately that's been interesting for you?
I think watching a lot more than anything else, but I think sports has been kind of the big theme. So, we had Athens hosted the NCAA tennis tournament. So that was fun back in May. And then you had the French Open tennis tournament. You had Wimbledon. You had the World Series, the College World Series mixed in with that, and then World Cup. So it's just been a lot of
Yeah.
fun. I think I've been more into sports this summer than probably ever before.
Yeah, that's great. That's awesome.
Yep,
I didn't realize there was so much local things going on too. And of course, all the World Cup in Atlanta.
yeah, absolutely,
So fun. Well, I'll let you get started. Thanks so much for hosting this today.
absolutely.
And
So
if
I'm gonna,
anyone has any questions, you can pop those in the chat box, the Q&A box, or you can raise your hand and we'll call on you. And we'll take all of those at the end. I'll let you go to it, Clarke.
okay, hang on one second. I'm gonna share my screen real quick. So everyone should be able to see full
Looks
screen, the
looks
title of this.
great.
Yep. So today we are covering all things IRA. So these are really strategies and things to help you save taxes and just get more out of IRA and IRA planning. It's such a huge topic, and we've got a lot to cover. I actually had to pare down some slides, and so, but it's very informative. There's some of this you may know already, some of this may be, so it might be just reiterating certain things. Some things you may not have thought about, but we'll go through these, and then certainly we can always talk after the webinar if you have specific questions that are important to you individually. So there are a lot of questions that we hear with IRAs from clients, and it's things like, can I contribute to an IRA? How much can I contribute? What type of IRA is best for me? And then there's things like, when do I need to take withdrawals? How are those withdrawals taxed? What happens if something, if I die, if I pass away? And then I think one of the biggest things that we hear is like, how do we minimize taxes when it comes to IRA planning? And so, because it's obviously very hard earned money, and we want to be able to minimize taxes wherever possible. So, just a quick backdrop, so many years ago, 50s, 60s, 70s, really more of the 60s, 70s, 80s, companies that 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 had employees had offered pensions. And so for the longest time that in those decades, pensions and then Social Security was really kind of the core foundation of retirement and income in retirement. And that has shifted over the years. And so companies now rarely have pension plans. If you have a pension, that's great. It's a great foundation to have in addition to other assets and other accounts. And so, but most companies now have 401k plans. And so that shifts the risk to the employee as far as how they allocate, what kind of risk level they take. But then also a lot of decisions in retirement, because there's no guarantee that the income will stay the same, or the account values will stay the same. So with pensions and obviously social, those are fixed incomes. You know what you're going to get. You can plan around it. So now retirees are responsible for making more of those critical decisions, keeping up with tax laws and things like that. So how long could we expect to live? And this is one that I hear from clients that they'll say, well, I probably will live till, I don't know, maybe another 10 years or 20 years or 30 years. And everybody's got a different opinion on that. But the numbers actually show that, for example, if you are a male, there's a 53% chance you're going to live to 85. And if you're a female, there's a 64% chance to live to 85. And then you can see at 90 and 95, the numbers go down, but even at 90, 32% chance for male, 43% chance for female. So we have to plan to live in retirement almost as long as we worked. So all that accumulation phase in our working years where we're contributing to accounts, 401ks, IRAs, we will likely live as long in retirement. So we have to figure out how can we have a sustainable income, and where do we pull from? How is that taxed? All those things. So just real quick, the one type of IRA, a traditional IRA, is just an individual retirement account. Everybody's heard of these. It offers certain tax benefits. Contributions may be tax deductible. The account grows tax deferred while the assets are inside the account or the funds are inside that account. And then withdrawals are generally added to your income. So when we pull money out of traditional IRAs, because it went in pre-tax, the money we pull out is ultimately taxed. And if we take money out prior to 59 and a half, there's an additional 10% penalty on that withdrawal. So how much can we contribute here? So it's for 2026, it's $7,500. And then if you're over 50, it's $8,600. And generally the rule is it's got to be earned income. You've got to have compensation equal to what you contribute. And there's no age limit on this. So, most of the time, if neither of you, if you or your spouse are not working, then you won't be able to contribute. And then we'll get into that in a minute, where you can actually leverage a working spouse's income for the non-working spouse to contribute to an IRA. So I mentioned earlier, the contributions are typically deductible unless you or your spouse are actively participating in a workplace retirement plan, and your income exceeds a certain amount or threshold. So those ones depend on your filing status with taxes, and then who's contributing to the employer-sponsored plan. So let's talk about a Roth IRA. And everybody's, I'm sure, has heard of a Roth IRA. So no deduction for contributions. So the money that we put into a Roth, we pay taxes on that. So just like an IRA or a traditional IRA, the growth inside the account is tax deferred. The key here is that the money that comes out, qualified distributions, the earnings, all that's tax free down the road. And so that's a very big benefit. So we pay taxes now for the benefit of not paying taxes later. And all that growth that we get over the years can make a big impact on our retirement plan. Again, talking about limits, contribution rules. So the limits are the same, whether it be a traditional IRA or a Roth IRA. $7,500, $8,600 if you're over 50, got to have compensation, no age limit. And there are some income levels that can prohibit you from contributing to a Roth. So if you'll think about it, if you're filing single and you make less than your income falls below 168,000, you can make that full contribution. And for married couples filing a joint return, that income's got to be below 252,000. So again, I mentioned earlier, a non-working spouse can make a contribution to a traditional or a Roth IRA using the working spouse's compensation. So that's a special contribution that allows, again, the spouse that's got the compensation, it does open that door for the non-working spouse to contribute. And so that's a big benefit. And if you just look at an example of saving systematically and the compounding growth that we can get in an IRA, I mean, look at just $8,000 a year. And this is assuming you have a 6% return. Again, we've got to plan on living to 90 or 95 potentially, maybe longer. So let's say that you just leave that account alone and you contribute and you're disciplined. By the time you reach 85, even if you never put another dollar in, and after those first 10 years, you'd end up with 350,000. And so it makes a big difference to do this automatically, systematically. Just kind of set it and forget it. And the return that you get may vary. It could be 6, it could be 8% or 9%, but it does make a huge difference to do this consistently. So this is obviously an IRA planning webinar presentation, but I do want to mention that we, everybody knows this, but you have to take advantage of your employer-sponsored retirement plans. So if you're working, you obviously want to know what type of plan you're offered, whether it's a 401k or a simple IRA, things like that. You can contribute money directly out of you could defer money directly out of your paycheck. And the limits are higher here. So the 2026 salary deferral limit, as you can see, is 24,500. It's 32,500 if you're over 50. And so this is a huge way to supplement your other income sources, maybe social, maybe a pension. But again, this kind of goes back to that first slide. The responsibility is on us to save for ourselves, to save for retirement. And so we have to be diligent. We have to be consistent and disciplined. And you want to make sure if you're in your employer-sponsored plan that you're at least getting the company match, if they offer a match. Not all companies do. So that's very important as well. So if you leave a company or if you retire after a long career, you have several options for your retirement plan, your employer-sponsored plan. So one would be to leave it in the plan, and you can do that. Number two, you can roll those assets to another company's retirement plan. So if you go from working for, say, UPS, and you go work for Home Depot, you can transfer that 401k plan from UPS into your Home Depot 401k plan. So that's an option. Third option is you can roll those assets to an IRA. You can take a lump sum distribution. You can convert your plan assets to a Roth IRA. And there are things that you have to be cognizant of there. Or you can make what's called an in-plan Roth conversion of your plan assets. So you have families and individuals are faced with lots of options when it comes to decisions that have to be made, whether when they're changing jobs or when they're retiring. And these all are very important decisions that we don't want to take lightly. So it's key to think long and hard and work, and hopefully work with an advisor that can help plan through and come up with the best strategy and the best choice for you. So if we're just looking at tax rates, so 2026 federal income tax brackets, you can see here we've got single and then married filing jointly. So obviously these are for non-Roth accounts. So when we're looking at withdrawing money from retirement accounts, again, when we withdraw money from IRAs or 401ks, that gets stacked onto our income. So we want to be very aware of where we fall as far as our tax bracket goes. And there's a lot of planning that has to go around that withdrawal strategy. Since these accounts are taxed, at ordinary income tax rates, just like interest on CDs or bonds is, again, we have that stacking of income. And so you can find yourself maybe going into another bracket. And this is just a quick slide on the top income tax rates throughout history. It's been pretty consistent since I would say early 90s, around close to 40, dipped a little bit back up. And so obviously prior to that, rates were much higher. And so it's kind of good to know where we are. Everybody feels like maybe the top tax rates are high, but if you look at that compared to history, we're in much better position today than in prior decades. So let's talk about potential side effects of IRA distributions. So obviously withdrawals can cost you in a lot more ways than just adding to your income. They can cause you to be phased out of itemized deductions, personal exemptions or various tax credits, can increase your exposure to that 3.8% surtax on net investment income. If you take an IRA withdrawal, you may have to include more of your Social Security benefits in income, and then could increase Medicare Part B premiums. So there are lots of things to think about. Obviously, and one of the big ones, I think, is just reducing or maybe just doing away with the option to contribute to a Roth IRA. So there are side effects that we have to be aware of and we have to plan around. And so, it takes time. We don't want to take these decisions lightly, and so we want to put a lot of thought and effort and kind of care into how we withdraw, how much we withdraw, and things like that. So required minimum distributions, and some of you've heard of RMDs. And some of you may not know what they are, or maybe you've heard of them, but you're not there yet. So RMDs are required at a certain point in your life from accounts where you have put money in pre-tax. So you can't avoid withdrawing money from your IRA forever. So you can delay it. And again, those assets continue to grow tax deferred. But it does kick the can down the road, so to speak, where your account can grow and compound more. And so Uncle Sam gets more of your hard-earned wealth later. So we've got to plan around RMDs. And for most, they begin once you turn 73. And the Secure Act actually increased RMD starting age from 72 to 73 if you were born between 1951 and 1959. So if you're born after 1960 or later, RMDs begin at age 75. So we've got to plan around this. And there are some things we can do to offset taxes as we get into this phase of distribution. And one thing you want to make sure of, you want to make sure you take your RMD. So because you could end up paying a 25% penalty, and that's avoidable. And so that's an easy thing to avoid. So you want to make sure you're on a schedule, you know what that has to be taken out, and you're doing that every year. So one thing I want to mention that is important, and that we see a lot of as far as people like being more charitably inclined, is something called a qualified charitable distribution. And this is really a tax savvy strategy that allows individuals that are 70 and a half or older to take money out of their traditional IRAs and send that to a qualified charity. And so the money goes straight to the charity or the entity, and without ever touching your bank account. So it basically means it isn't counted as taxable income to you. So for example, if you have an IRA and your required minimum distribution is $30,000 in a particular calendar year, you have the option, if you're inclined to do this, you can give $10,000 to your church, $10,000 to your college alma mater, and you could give $10,000 to the Humane Society. So you can take your RMD, use that as that QCD, that qualified charitable distribution, and you don't pay taxes on that $30,000. And the reason that's important, if you're giving already and you're giving money, and say you're writing checks from your checking account, you can keep that money in your checking or in your emergency savings or savings account and use the RMD to give to charity. So that's a big benefit. We see this a lot. We have so many clients that utilize this strategy, and it's very beneficial. So there's obviously calculations that go into your RMD. It's all based on your 12/31 balance at the prior year end, and then you've got this life expectancy factor that you have to consider. And the way we help people is we actually keep people on a schedule. They know what their RMD is. We know that very early on because we get that 12/31 balance. And then we can plan with and tailor a strategy, whether that be monthly, quarterly, just a one-time payment, whether QCDs are involved, and all those things. And so it makes a lot of sense to be working, at least if you're in this category, to work with somebody that can help you plan this out, because there are some pitfalls as well with RMDs that we'll talk about in just a minute. Just a quick slide on RMDs as a percentage of your account balance. So you can see you've got the age of the IRA owner on the left, and to the right, just an approximate percentage of your RMD that would need to come out. And so this just kind of gives you an idea of how much, again, a percentage of your total IRA balance or balances. So RMD mistakes, and we'll get into these a little bit. Basically, some of the mistakes I've seen and that I've heard about is aggregating RMDs from different types of retirement accounts. So for example, let's say you have a 401k plan and you have an IRA, and you've calculated your RMD for each account, and for the 401k plan, it's $4,000. For the IRA, it's $3,000. So a total of $7,000. So say, for example, your IRA is earning a higher rate of return than your 401k. So you might be tempted just to pull the full $7,000 from your 401k and leave the IRA alone. Seems like there's no harm in that, because since they're both retirement accounts. But you're not able to do that. And so it's pretty logical to think it that way, but the tax rules are anything but logical. So they prohibit you from doing that. And so an RMD for one type of retirement account, like an IRA, can never be taken from another type of retirement account, like a 401k. And then another mistake would be aggregating RMDs between spouses. So another common error that we see, or that I've seen, it doesn't really happen with us because we obviously are planning to avoid these mistakes up front. But I've had people come to me that have been through this that were not clients, and they needed help on trying to avoid these things and these pitfalls. And so in this case, say for example, you've got a spouse, you file a joint return, you have an RMD for your IRA of 4,000, and your spouse has an RMD for 2,000. So to make things easy, you just simply take 6,000 out of your IRA. So you feel like you've covered the total amount that's required. They're both IRAs. You file jointly. It makes sense. It feels like it would work. The income will show up on the same return, things like that. Retirement accounts are individual accounts. So there's no such thing as a joint IRA or a joint 401k. So you must always take your own RMD. So aggregating RMDs between spouses is another mistake that I've seen. And then a third one's just forgetting to take the RMD. And that's where you get into that 25% penalty. And what I've seen with people is the most common, or the most frequent I've seen as far as forgetting to take RMDs are people that we meet that aren't working with someone already, like a wealth advisor or a financial planner. Because if you are working with somebody, they've got you on schedule. They are tracking this for you. They're making sure this gets executed and that everything gets done the correct way. And so forgetting to take it's another big mistake. So just a couple of strategies. Hold off on taking IRA distributions. So some potential benefits here. The IRA funds do grow tax deferred, right? We like that. The compounding growth. It's you're not paying taxes on dividends, anything going on inside the account. It's just growing tax deferred. It keeps that income from your IRA off the tax return. And some people might think that's great for as long as they can as possibly do it. And so that's a potential benefit. And then avoiding the potential side effects of an IRA distributions for as long as possible. So, there are some benefits there, but there's also some drawbacks. And so as that IRA grows and it's continuing to defer the taxes on that growth, the government is going to get more down the road. So at 73, when you start taking RMDs, that RMD amount is going to be larger. So, again, distributions in future years may be higher, which could put you in a different tax bracket. And so that's something to consider. Another future side effect could be, increase in the amount of how much you're taxed on Social Security, or increase in Medicare Part B premiums. And then also future tax rates might be higher. We don't know. I'm of the belief that we are in a very favorable tax environment right now. You hear people say maybe down the road, 10 years down the road, 15 years down the road, tax rates could be higher. So that is a possibility. So Roth IRA conversions is another strategy we want to talk about. And you've probably heard of these. It's a huge benefit, and we have a lot of people that do this. And so in this scenario, you're taking money in a traditional IRA and you're moving it to a Roth IRA. And so, for example, let's say you have $100,000 in a traditional IRA and you'd like to convert it to a Roth IRA. If you move forward with this, you'll add $100,000 to your income, or to your tax return for that year, which could be whatever rate you're in, whatever tax bracket you're in. That it could not just it could bump you up, and obviously in your tax bracket, but it could be a significant impact on your taxes. So that amount that's converted is added to your income. So it's a big decision. It could have a big impact on your taxes. So it's always best to discuss this with somebody, your wealth advisor, your CPA, just to make sure that the amount is correct. You're not converting more than, you're not converting so much that it's going to be adversely affecting your taxes. So a lot of planning goes into conversions, and you can see why. And tax-free Roth IRA distributions, we talked about earlier, the big benefit for the Roth, grows tax-free, comes out tax-free. So all your distributions from a Roth are tax and penalty free if you've had the Roth for more than 5 years and you're at least 59 and a half. If you're older than 59 and a half, the amount you can convert can be distributed at any time. If you're older than 59 and a half, the amount you convert can be distributed, right? At any time, tax and penalty free. So who can do a Roth conversion? Anybody can convert their Roth IRA convert to a Roth IRA. So there's no age limit, there's no income limit. You don't have to be working. We talked earlier about if you want to contribute to a Roth IRA, there are income phase outs or limits. So if you're a high income earner, you may be above that amount and you can't contribute to a Roth. However, regardless of your income, you can make $1 million a year. You can convert to a Roth IRA. But again, there's a lot of planning that goes into that because a high income earner obviously is going to be in a higher tax bracket. So, you want to plan around that, come up with the best strategy. What kind of schedule do you want to do that on? Spread that out over multiple years so you can spread those taxes out. So Roth conversions, the potential tax-free nature of the Roth, it can give you some additional benefits, such as like a hedge against tax rates down the road. We talked about what future tax rates might look like. And so could be a good hedge against higher rates down the road. Taxes are a huge concern for people. It's unpredictable because it can vary from different, for whatever reason. There's either whether it's administrations or that are in office that tax rates can change for different administrations, and so we want to be careful not to try to predict or try to forecast what tax rates might be. Look at history. I think, again, I said earlier, I think we're in a favorable tax environment right now if you compare it to history. And so could they be higher in 10 years? I think there's a good chance they could be. So you want to be careful there. And it can help you manage other costs tied to income, like, again, whether it be Medicare or more of your Social Security benefits being included in your income as far as taxes. One of the nice things about a Roth IRA is there are no RMDs. So for your entire life, you can have this Roth IRA growing tax deferred. You can have income coming out tax free, but you don't have to take RMDs at 73 or 75. So that's a huge benefit. So during your lifetime, you can take as much or as little as you want out. You're not forced to take it out. And that means that Roth IRA can continue to grow. And sometimes what we think about or what we see is people that have substantial assets. The Roth IRA can sometimes be sort of a legacy type asset or planning for your beneficiaries because those RMDs aren't having to come out. So having that right balance of whether it be a traditional IRA, Roth IRA assets, or even tax advantaged assets, it is very important. So I think the more money we can get into Roth IRAs, the better off we are. It's not easy. It's not perfect. By default, a lot of us are always going to have a good amount of money in pre-tax accounts because that's where most of our employer plans are. That's how most of our employer plans are set up. And so, but if we can have, and I'll make just a side note, if we were able to have some pre-tax assets, maybe that we accumulated through our working years, if we can have some Roth assets, and if we can have that third category or that third bucket, tax, I call it after tax. It's money, it's an account just like an individual or joint account where you've paid taxes on the money, but it's in an account that's invested for retirement. Those three buckets combined can be very powerful through retirement. So the Tax Cuts and Jobs Act eliminated recharacterizing conversions. So before 2018, you could convert to a Roth and then you could basically undo that. But that was changed in 2018. And so when you convert, you are now stuck with the conversion. So a couple of questions to think about when you are converting. So it's very important that you're sure you want to convert to your Roth IRA before you do anything. So the three questions to ask yourself, or that we like to go through with clients, is do you have a kind of a rough idea of the conversion's impact on your tax bill? Do you have a plan to pay the tax? How are we going to cover that tax bill? And then do you have like a reasonable expectation, right? So that the benefits of prepaying the tax make sense in your overall plan. And so again, this is where we want to pay taxes now and avoid paying taxes later, especially if we think rates will be higher. And if we're looking at, conversion strategies, we've got these, we looked earlier at the different tax brackets. So sometimes you can find yourself in the middle of one of those tax brackets, and you got a little room there to add more income without pushing yourself into a higher bracket. So for example, in 2026, the 22% bracket for a married couple goes from a little over 100,000 to about 211,000. So suppose that you file a joint return and your taxable income is 100,000. That means you could basically add another 100,000 of income without going into that next bracket. So you could make a strong case for doing a Roth conversion of that remaining amount to fill up that bucket. Another optimal time to consider conversions is if you have a low income year. Unfortunately, sometimes we may be in a position where companies have layoffs, or we're changing jobs, and maybe we've taken a job with a lower income, a lower salary. So those low income years, regardless of the circumstances, could be a good time or a beneficial time to look at converting. And I would also add to that, another opportune time could be with the market. What if the market drops? And that's not on this slide, but if we had a market and markets drop, we know that markets go up and down, and we know that every year the market might go down on average about 15% at some point during the year. Sometimes it could be more. So if we had a market decline, or if we had a low income year, those could be considered good times to convert money from a traditional IRA to a Roth IRA. So just some limitations and risk involved as far as Roth IRA conversion. So, there are no guarantees, obviously, but certainly that the IRA conversion will achieve the results we want. We know that. There's no guarantee the rules won't be changed. And I hear that a lot. I mean, the Roth IRA sometimes sounds too good to be true. And it is a great vehicle for saving for retirement. But there's no guarantee that those rules won't be changed. The amount converted is added to your income. And so we've got to consider that. It could, again, trigger those side effects we talked about. And there's no guarantee the investments will appreciate in the Roth account after a conversion. Typically, we would want to hold more growth-oriented investments in our Roth. So that's a whole different subject that we can get into after this webinar. But typically, it's my view and that you would want to hold more growth-oriented assets in the Roth account. So another strategy is moving retirement money directly versus indirectly. And so there's two ways we can move retirement money, because you've probably come across this at some point during your life. You're going to want to move some money from your retirement plan at work to an IRA, things like that. And so there's generally two ways we can do this. You can either move it indirectly, and that's known as the 60-day rollover, or you can move it directly. Typically, directly is the most advantageous way, the most prudent way to do it, and we'll look at that real quick so I can share the how this works. So indirect rollovers. So you have an IRA account or a retirement account, like at work, and you take a distribution payable to you. Check is made out to you, and you have 60 days to get that into your new retirement account. Now, if it's a 401k plan, the 401k is going to withhold a mandatory 20%. And so this is, I think, the least efficient way, and not the, again, it's not the most prudent way to handle transferring money from a retirement account to another retirement account. So the best way to handle this is doing a direct transfer. And if we do it like a direct rollover or a trustee to trustee transfer is what it's called, the funds are sent from your old retirement account to your new retirement account. Now, that doesn't mean the check might not come in the mail to your house. It likely will come to the address of record, but the check's not made out to you. And that's the key. The check's made out to the new trustee or the new custodian. So there's no 60-day rule here. There's no mandatory 20%. And I'll back up real quick. The indirect rollover, you can do this once per year. So that's the rule. And again, that doesn't apply if you're doing a direct rollover. So if you get a check, for example, from your 401k plan, and maybe you've just retired and you're rolling your 401k plan assets into an IRA, a traditional IRA, or a Roth IRA, it's made out to the custodian. So, for example, if Charles Schwab is the custodian, the check's made out to Charles Schwab FBO for the benefit of John Smith. And so that's a direct rollover. And typically these checks get mailed to the address of record, as I mentioned, and then you just have to get that to your advisor or into your Schwab account in that example. So again, continuing on with IRA strategies. So IRA planning, there's many components of trying to be savvy with our IRA planning. And so you want to coordinate that with your overall retirement estate plan, and your overall financial plan. So, because it can have a big impact on other areas. So we often talk about asset location. And so it's not just, and this slide says, it's not just what you own, but it's where you own it. So, many of you have your savings and retirement accounts, but also you've probably had some savings in IRAs, 401ks, and other types of accounts, maybe non-retirement accounts. And I talked about those tax buckets earlier, the pre-tax bucket, the Roth bucket, and the after-tax or tax advantage bucket. So if that's the case for you, one strategy is consider coordinating your IRA with your overall plan and selecting which investments are in which account, because those accounts are taxed differently when money comes out or when there's growth in the account. And so this could lower your tax bill, actually. So a quick example, if you have $100,000 in an IRA, and then you also have $100,000 in a non-IRA account, and let's say you're in a 24% bracket, and you want to own $100,000 in bonds paying 4%, and you want to own $100,000 in stocks paying qualified dividends in aggregate of 4%. So the example is, so let's say the IRA, and this is on the left side, if the IRA owns the stocks and the non-IRA owns the bonds, how does that look for us as far as our tax bill? So the dividends are going to give you $4,000 of income in the IRA. And if you withdraw from that IRA, you're in that 24% bracket. Your tax bill is $960. So over here in the non-IRA account, and again, when I say non-IRA account, that I also refer to that as the tax advantaged account or the after-tax account. So bond interest is taxed at ordinary income. So we've got $4,000 in interest at the same tax rate. And so wouldn't it be smart to consider switching that around? So put the bonds in the IRA, put the stocks in the non-IRA, and our total tax results in a lower tax bill. So, and there are obviously more benefits with having stocks in non-IRA accounts. You also have the ability to do tax loss harvesting. We've got capital gains rates, which could be more favorable in a lot of cases than your ordinary income tax rate. So there's some big benefits to asset location. So it's not just, I want to have, you don't want to put all the same asset, in other words, if you're trying to do this cookie cutter, you're putting stocks and bonds in one account and stocks and bonds in another account, that may not make sense. And you really want to be careful where the bonds are held versus where the stocks are held. And I mentioned earlier, the Roth would be a great place to have the stocks, because that growth, the more growth there, the more wealth is created over that time in retirement, and then no taxes when you withdraw money from there. There are some, again, we don't know how the investments will perform. Not all dividends qualify for, the special tax rates that we get with qualified dividends. And tax rates could change. So there's no guarantee the special tax rate for long-term gains won't be changed. There's been conversations in Congress about that. So there are a lot of variables that could change. But right now, if we, knowing what we know, we have to be strategic about where we put our assets. And we want to plan around, with our IRAs, we want to plan around Social Security, obviously. So many people don't evaluate properly when to apply. A lot of people apply early for different reasons. So, Social's guaranteed income for life. And so it's an important decision. It's a huge decision. We put a lot of thought and effort into the planning that goes around this for clients. Delaying that, at least until full retirement age can be a big benefit, because that can increase what you're receiving. So there's a lot of planning that needs to go be considered when we're talking about IRA planning and how that works with what we're going to be looking at as far as when to apply for Social, those types of things. And then coordinating with, your estate planning. IRAs are important considerations when we're talking about how are we going to pass these accounts on to our beneficiaries. Your will does not control, if you have a beneficiary listed, that transfers direct to the beneficiary. So it's bypassing the will. So you want to make sure you want to appropriately plan for beneficiaries, because if you don't, it can lead to some big problems and some big headaches for sure. So I'm going to jump ahead real quick. So we've got, with IRAs, we've got what's called eligible designated beneficiaries. So obviously that's spouses. We've got disabled persons. It could be somebody with, a chronic illness, individuals within 10 years of the decedent's age, IRA owners, minor children up to a certain age. And so, the Secure Act created eligible designated beneficiaries. And this gives this group the option or the benefit to stretch distributions out. And so that's a huge benefit for these different categories. And if I jump back, so if you look at non-eligible beneficiaries, the account's got to be distributed by the end of the 10th year of the date of death of the decedent. And so unfortunately, the Secure Act eliminated the tax benefit for regular designated beneficiaries. Now it's just we've got the non-eligible and then the eligible. And so you've got to consider, if you inherit an IRA and you're a non-eligible beneficiary, you've got to get that money out within the 10th year. And so those of you who expect to pass a large amount of retirement assets to heirs, you got to be mindful, and you've got to plan around things like that. And if anything, maybe start looking at converting to Roths and things of those nature. The new 10-year rule for most IRA beneficiaries started in 2020. And so again, it goes back to planning. A lot of planning goes into IRAs, and how do we coordinate that with our estate plan? Who are our beneficiaries? Is it our spouse? Is it our children? Could it be an entity like a charitable organization, things like that? So back to the stretch for those that qualify, it's basically the withdrawals are stretched out over their life expectancy. And it gives you that longer term preservation of, I guess, tax deferral for as long as possible. It just helps minimize the tax that we pay on withdrawals. So that's a big deal. And in contrast, all of the beneficiaries typically have to withdraw this money much sooner. So options for spousal IRA beneficiaries. So a spouse can do a spousal rollover in this case. So many people name their spouses, most do. If you're married, and they're obviously, again, that's passing outside the will. So let's talk about that for a minute. If your spouse is your sole IRA beneficiary, they'll have a couple options. So they can, again, remain the beneficiary on the account. Basically, it's treating it as their own. So, for example, so the spouse moves the IRA assets from the deceased spouse into their own IRA, and it's just treated really as if it had been their IRA the whole time. And again, if future distributions are subject to that 10% early withdrawal penalty if they're not older than 59.5. So another option that's very beneficial to a spouse beneficiary is if you remain the beneficiary of the inherited account. So this is generally like the preferred option. If a spouse inherits prior to turning 59.5, because it allows them to start taking penalty-free, and that's the key, penalty-free distributions from the inherited account, regardless of their age. So in contrast to that, if they were to do the spousal rollover, the money then gets treated as their own. And if they take distributions prior to 59.5, they would be assessed a 10% penalty. So this is important if a spouse needs money, needs income, maybe needs to pay for final expenses and things like that. This could be a good option. So we covered a lot, and I think I don't know if I mentioned this earlier, but there's so much material here. Even if you dig into each topic or each strategy, I still had to pare down some of the number of slides. So this could go on for an hour, but there's probably lots of questions. There's lots of things you're thinking about or have thought about. I think it's important to if you're kind of going down the line on these bullet points, do evaluate your employer plan. And I would also tell you to evaluate, to find out if your employer plan has a Roth option. So your 401k could have a Roth 401k option. So how do we move money from retirement account to retirement account in the most efficient way? How do we distribute money? How's that tax? Should we convert? How do I plan around all these other things? And so, how does it pass to the right beneficiary? And we're always here to help. So if people have, if you have concerns, questions, want to dig deeper into any of these things, you can reach out to Betsy or reach out to me or any of us on our team at Elevate, and we'd be happy to talk with you and cover those. And so I just appreciate you joining us and taking time out of your day. I feel like I hope this was insightful. And so, and I'll just turn it back over to Betsy.
Thank you so much, Clarke. That was fantastic. We really appreciate your insight today. We do have a couple questions, so if you don't mind sticking around for a second.
Sure.
One person asked, should I convert my traditional IRA to a Roth?
So that's a good question, always a great question. And the answer is, it depends. The Roth conversion can be a great strategy, especially if you're in a relatively low tax bracket. It could be a good strategy if you're maybe in a higher tax bracket too. You can make the case. And so, but if you expect to be in a higher tax bracket later, obviously there's some trade-offs there. But what you're doing is essentially you're exchanging, you're paying taxes now for tax-free growth and tax-free withdrawals in the future. And so just again, you want to make sure you know the impact on your tax return before doing conversions. But no, I do believe I'm a big fan of the Roth IRA. And so anyway, so.
Thank you. Should I wait till I'm required to take withdrawals from my IRA?
Should I wait? Okay, so another good question that we get, and I would say not necessarily. So waiting to take RMDs or waiting until RMDs begin allows your IRA really to keep growing tax deferred. It can also, though, create larger required withdrawals later in retirement. So in many cases, taking smaller withdrawals or maybe doing or completing partial Roth conversions before RMD age can reduce taxes over your lifetime. So the right answer here is it just really depends on your overall tax situation.
Very good. Thank you. And what's the biggest mistake that you see people make? You did mention a couple of them, but what's the biggest mistake you see people make with their IRA?
I'd probably say people making decisions in isolation. So like it might be missing an RMD. That could be one. It could be completing a Roth conversion without having any understanding of the tax impact. Mm-hmm. Or it might be failing to or forgetting to update beneficiary forms. And so, life changes. We could have somebody pass away that's a beneficiary. We could be divorced. And so we want to make sure we're updating beneficiary forms because that can lead to big headaches. But the biggest mistakes usually are kind of like, usually happen when IRA decisions aren't coordinated with your other planning, like tax planning, estate planning, overall retirement strategy. So that's why planning is so important.
Thank you. Thank you so much, Clarke, for your time today and for all this preparation. We are doing a tax or a retirement planning today course coming up in August at UGA. If anyone's interested, my email address is marketing@elevate-wealth.com. I can send you information about that. We also have a YouTube channel and we have weekly videos. Clarke's been exploring different retirement strategies this whole month. And he does go into a little bit more detail on things like tax loss harvesting and some of the other strategies he mentioned today. So definitely go to our YouTube channel, look for Elevate Wealth, and you can dive into some of those playlists to get some more information about that. We did have a couple more questions, Clarke, but I'm just going to let you answer those via email because they're a little bit more in depth. But we just appreciate everyone's time today. And we're going to look forward to seeing you at our next webinar in August, where we will go over some Social Security planning topics. Thanks, everybody, and have a wonderful rest of your summer. Thanks again, Clarke.
Thanks. You're welcome. Thanks, Betsy.
Take care. Bye.